Dum, 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 dum. Tim, what's going on?
Mitch, good to see you. So I hear you're some kind of workout freak. Is this
No, just
information
it's the
correct?
comeback tour. It's the
It's the
comeback tour.
comeback tour. It
Yeah,
looks like
Tim.
you're.
I haven't played baseball in a couple years, so I'm trying to come back.
I
The chat
see.
said I couldn't hit plus 90, so we got to show them.
You can't hit a 90-mile an hour
Not only am I
fastball.
going to hit 90,
Now you
but then I'm going to hit it back at 90 exit speed. Get ready for that. Tim.
The
Get ready.
the equal and opposite reaction. There we go.
Boom.
The laws of motion.
Rebound effect,
I like
right?
that. Yes.
Come on, bring it. Woo-hoo, they don't want it.
That's
I'll throw
math.
you a
That's what
change
I
up,
love.
man, and you'll be swinging out of your shoes. You'll be on the
Well,
ground.
Well, the truth is, I need some analytics on my side. That's what I need, Tim. I'm
Always.
using the analytics. I'm working out with the math in my head, right?
Moneyball.
Always.
It's all about
Moneyball
the
approach,
analytics.
baby.
That's right.
Let's get into the analytics. Let's take a look at what market structure Edge is telling us right now. Seems
Well-
like last week you were telling us we could have a turn. I think I remember somebody talking about that.
Yes, and it's not, it's not that I'm right, but the math is usually right. The good news about the market structure, if you think the word market structure is a great way to clear a room at a cocktail party. I guess that's two words. But the beautiful thing about market structure to me is that it reflects everything that's known. So we could have a conversation about the expectations for economically. I think you guys were talking about this. What the job market is like. Do we have a soft landing? Do we have no landing economically? Do we have a hard landing? What everybody thinks is reflected in the math, and it can be very helpful. You could look at the math for Home Depot, and you could say, well, the demand died in December, and there were short bets at January options expirations. What's the probability that Home Depot declines? Because that information reflects what everybody knows. It reflects what hedge funds consume. They buy the data. They look at the supply chain, the credit card data, the satellite imagery. They know everything. So that's my setup. The introduction to where the data are as we sit here at February options expirations. It's the whole cycle. I didn't hear one person yesterday mention that we had a confluence of events yesterday. New options were trading at the same time that banks that traffic in those, that make markets in options, had to square the books on the ones that lapsed last week. Well, if you have both things happening at the same time, what is the probability of elevated volatility? Well, it's mathematically a higher probability. To me, what you then look for is what is the supply-demand balance as that event is occurring? Well, we could see it coming last Monday, that if you looked at broad market sentiment, and they're just measures. There are moving averages, there's this thing, there's that thing that you can look at to try to understand what the market is doing. This is a measure. The good news about it is it reflects all of the buying and selling. And is the net of buying and selling producing rising demand or weakening demand? And is the net of buying and selling causing increased or decreased supply? Well, here's where the stock market is. Here's options expirations last week. I'll zoom this in a little bit. This is SPY, been very volatile. This is the demand cycle. So as it begins to fall, it's actually leveled off here. The likelihood that the market rises as demand is falling is very low. It's just a statistical fact. Then if you look at the supply side, more than half of all market volume is short. That reflects everything that's known. So if more than half of the volume in the S&P 500, it's not short interest, people, that is a 1974 measure, back when we last had inflation. It's not relevant to the way that the market works today. This is short volume. It is the data set associated with Reg SHO Rule 201, the modified uptick rule. Well, if you put all the macroeconomic models together, the hedge funds, the trend followers, all of that stuff, ETFs heavily shorted, You put it all together and you go, well, son of a gun. Demand is falling and supply is above 50% of all volume. What is the probability that the market declines? Well, it's almost 100%. Just like it's almost 100% probable that when the market bottoms and demand begins to rise and supply falls, that the market will rise. And
The only time, Tim,
Yes.
just looking at your graph here, the only time I can see it kind of similar is from like that 12.15 to maybe like 12.20, where you were seeing very similar situation, right? Rise in supply and and broad sentiment going down.
Exactly. And that's where the market, hit post-September lows there.
So where are we now, Tim? I mean, obviously we know we had a significant run in January. We've given some of that back here in February. I've been arguing for a range-bound market where we just kind of go sideways and chop up here for the foreseeable future. But what is your system predicting for the next couple of weeks?
Well, it depends on what happens this week to me, Dennis. If we see a reversal of this supply-demand relationship, if they stop converging and resume diverging, we're fine. If we don't, I would say we're right on a precipice. And the market renders fools of all of us. And Dennis, you were talking about, you admit when you're wrong and you move on. So I may be admitting next week that I'm wrong and we'll move on, but I'll say that we are at a precipice here. If we do not get our footing this week, we will carome lower and it will be fairly violent. And that's because you cannot remain in stasis if demand falls and supply rises. Something has to give until those conditions change. And it's just a supply-demand feature. And let me expand this out and give you, this is my grand unified theory. So if I expand this view out 3 years, and it will show this is demand, and it constantly changes because the market is very short term, but you can see the general trend in nature. This is SPY, and this is supply. So if we just take those 3 things and put them together, I can unfold for you what has occurred and what is occurring. So here's the thing. The great pandemic momentum market that created the highest highs we've ever seen ran out of steam right here. This was May, options expirations of May 2021. But there was so much fuel. It's like launching a rocket. And then you consume all the fuel, and the rocket continues to rise for a while. But that data is telling you it's going to start to arc back down. Now, it took a while, but look now at the supply side. From the pandemic all the way to roughly November of 2021, the supply side trailed the trend. Insufficient supply, a lot of fuel, but it turned right here. And that was the peak for the market. So then if you look at what has occurred since then, we're spending a lot more time below 5. Demand has faltered. This is not finished yet. People think, oh, we've hit our lows. Now we're going to return to an economy that's growing and the behavior in the market will reflect that. I look at this and say, that has not happened because all of the all-time highs for supply have been set since September. September is when we hit our all-time post-pandemic lows, and we have not left that pattern. So I think we have more trouble to come. Unless and until these conditions change, it's going to be challenging. Now, traders and investors, it doesn't matter. I've had a great, I'm up 20-some% in 2023 by trading short-term momentum, short-term low volatility, depending on where the market is going. I don't care about these conditions, but it should influence your longer-term commitment to equities and bonds. If you look at the data and they tell you, well, the propensity of the market is to continue to have trouble, then you want to have less exposure to those risk assets. When these conditions are awesome and you have great momentum and insufficient supply, we'll put a lot of money into the market. So that's where I think we are. And we can talk specifically about what happens next, but I don't think we're out of the woods yet.
Yeah, we can definitely take a look at what happens next. I'm sure everybody out there wants to know if there's any sectors or industries that you're seeing that are pointing towards that supply coming down and maybe demand coming up.
I'll tell you, Mitch, it's difficult. And here's what I look at every day. This, by the way, is the Edge dashboard. So I come to the two portfolios that the math creates automatically for all of us. It's what I use. So when there are 35, 20, 25, 30, 35 components in momentum, I know that momentum abounds. Well, look at how many are in it. 5. They're just 5 in momentum across thousands of securities. You look at low volatility, which is the flip side. If the market is troubled, you want to go into the eddies and bays where the money will cluster because those things will have a tendency to outperform. Only 7. So it's neither a momentum market nor a low volatility market. So what then is it? It's a market that can behave very unpredictably. And if I look across the sectors, here's big tech. Is big tech okay? Well, it's getting close to a bottom. Supply has come down, demand's leveling off, could be opportunity ahead. Communication services, a wreck, way too much supply, not enough demand. Consumer discretionary, way too much supply, not enough demand. Consumer staples, too much supply, not enough demand. Staples is better than discretionary, but none of those are good. I look at that and say the core of the market does not give me the warm fuzzies. The only thing that I would look at is I have 2 for today. If I picked one thing that we could highlight out of momentum and one thing out of low volatility, hang on, I'll tell you what they are. That doesn't mean that they're going to perform well, but this is the 2 that I would point out. In momentum, the last thing left is Allegro Microsystems, ALGM. If I look at the supply-demand balance in ALGM, it still tells me it has a possibility of delivering returns because demand is at 10 and supply is declining. The price could rise. If the NASDAQ is up today, that stock could be up what? Well, if it's up 3%, that's a very good day because it moves about 3.8% per day. If it's down 2%, well, that's a good opportunity because there's a high probability it will produce a return. But that's one stock. And then I'd look at Coke. Coke is the flip side.
Coca-Cola.
On a low volatility trade, you want things that spend a lot of time at 5 and have diminishing supply. Well, there's Coke. And that is it. I don't know what else you would do. I tell people there are times when there is very low risk and a lot of opportunity, plentiful opportunity, and there are times when there is very high risk and limited opportunity, and we are in the latter right now.
And I mean, Coke is defensive. So if you think we're in a tougher market, Coke just makes sense because it's a defensive stock. It's pulled 4 or 5 points off from the highs. Yep. I could get on board. I mean, it's not going to kill it. I've been saying for a while, though, if you really want to take market risk, and you're going for a Coke that you're trying to pick up 3, 4, 5%, maybe you just go in cash. But I like the cash better than the staples. But I think the staples are going to be fine. So
I'm with you, Dennis. In my trading account, which is at Interactive Brokers, I am 100% cash. I went wholly to cash on Friday, and I had to work at it. I was very happy with my trade in Arista Networks, ANET, just to get out level. I mean, I own Coke. I sold it. I might buy it again, but I can earn 4% on my cash. Do
you see the rate at IBKR? It's pretty good. Just sitting it in your trading account. There's got to be nobody that's that high. No other broker's got to be that high. Just sitting in your margin account ready for trading. Exactly. I think it's like 4.06% right now in US dollars.
Exactly. And what they're doing, it's an arbitrage trade. They're parking that money as an excess reserve at the Fed, where they're getting paid 4.68 on it, and they're returning.
Good old arb. Hey, you got anything on the dollar, Tim? Real quick. Someone asked about the dollar. Can you do that real quick in 30 seconds?
Yeah, let me give it a try. So let's pull up DXY.
Where are you at, by the way? You're in a new place.
I'm actually in Denver, and it was 60 degrees here yesterday. And when I left Steamboat Springs yesterday morning, it was 2. Today it's 12 and snowing in Denver.
Volatility. Buy the dip. Exactly. Buy the dip and sell the rip. Real quick, the dollar, Tim.
Dollar. Here we are. DXY. It's a global basket. Dollar has bottomed and is rising. If I look at the dollar, so what does that mean for overall risk assets? Tends to constrain them. I think it's why energy has faltered a little bit. There are energy plays and momentum, but they're not great. I'm going to watch this. If the dollar weakens, I'm going into energy again. But that's where we are.
Well, thank you for joining us. Like always, you guys can check out Market Structure Edge for yourself. And of course, use that promo code Benzinga, and you can get up to a full month now. Check it out, team. Get on that Market Structure Edge. You might want some math on your side.
That's right.
Appreciate you, Tim. Have a good one. We'll have you back on.
Too. Thank you.
Take care.